It's been a strong start to the second quarter earnings season. After a very good Q1 earnings season, both Wall Street and Main Street seem to want to see more standout reports along with AI productivity gains. Our research director, Shiraz Mian, is here now to tell us if they'll get their wish. Shiraz, the big banks marked the official kickoff as always. After a record Q1, did they show that they have more room to run here?
In terms of earnings growth and momentum, definitely, Terry, on all of their core businesses, they showed a clear improvement in the Q2 results. And on the whole, the takeaway from management's commentary and even explicit guidance to the extent some of them gave us was very reassuring, painted a picture of stable and steadily improving outlook. So on the whole, I would say the earnings picture for the banks looks very, very good.
Do you see the higher gas prices and high AI valuations hampering lending and deal making for them at all?
On the whole, gets brought up as a positive, not the gas prices bit, but the AI seems to be this one trend that's driving businesses across the board, not just in finance, uh, but in a variety of sectors. So it is positive for them, not just in lending, but in a host of other activities too, including trading for those that have the universal banking model, the brokerages, and then deal flow as well. It has a read through for the broader economy, and these, as we all know, banks are truly economically sensitive and more of a domestic centric, economically sensitive businesses, and the AI centric spending is the most dominant economic trend, and absolutely, it has a positive impact. The gasoline is a negative. Uh, Q2 itself wasn't too bad because, as you would recall, Terry, at the beginning of the quarter, we were all concerned, and things eased up, and now in recent days, things are again moving in the wrong direction. So that's I would put that in the negative category.
Saw IBM pulled a surprise. They released their preliminary earnings a week ahead of schedule, citing a miss on revenue and profits. Stock took a hit after that news. Is that one of the few negatives that you've seen so far?
So it could be, and that was why the market reacted so negatively to the IBM's results. IBM, there are some company-specific things going on. The company has had a good run-up in recent quarters, and after struggling for many years, and it appeared that under the current management, the business had turned around and had found its own niche in this emerging AI world. And this pre-announcement put something of a dampener on that. Now, there is one school of thought on the street that believes that management's uh, explanation for the pre-announcement that some larger deals got pushed into the following quarter is valid and legit, and the overall positive story about IBM is still intact. And then there is another explanation narrative as well, which says that this ongoing AI related spending is kind of crowding out uh, other tech related spending activities on which companies like IBM are heavily reliant. And if that is really an emerging theme, then that's a problem for a host of companies, including IBM.
Okay, let's see what the scorecard looks like so far.
So, including all of the results that came out through this morning, we now have 121 S&P 500 companies have reported. As you know, Alphabet and Tesla reported last evening, so they are all included in the results here too. So about 24% of the index membership, and we have uh, some blockbuster results included in these 121. That's distorting the trend line somewhat, Trady. Uh, Last night's Google has this unrealized gain from its equity investment in SpaceX. So a huge growth number for them. Prior to that, Micron had this blockbuster. But let me just give you the headline growth numbers, and then we could talk about how they look on an X tech basis. Uh, but earnings are up 72%. And don't jump from your chair. That is a real growth number. Revenues are up 13%, 86.8% are beating EPS estimates, and 80% are beating revenue estimates. If we strip out tech, because Google had these blockbuster numbers and Micron had uh, these blockbuster numbers, then earnings growth drops to 17.8% and revenue growth drops to 9.5%. All of these are record numbers, the growth rates, the beats percentages, and the earnings picture was fairly positive to begin with, and these results are painting an even more robust and positive picture.
Yeah, that stripping out business, I'm skeptical of it. It's like saying if I don't have that cheesecake for dessert today, I'm going to only weigh 165 pounds. I mean,
That's a good way to look at it,
yeah.
Terry. Yes.
Are margins going to tell the story, by the way, as to whether these earnings can keep up their current pace?
Yes, they are. I'm not sure how do you feel about the stripping out business anymore. But if you look at all the companies that have reported, it's off the charts. It's in record territory, very strong margin growth, and the picture looks equally impressive if you take out some of these unusually strong numbers like Alphabet and Micron. And just a quick comment on uh, this, as you know, Terry, we are in the data business. We tabulate these results, and a lot of our clients, both individual investors as well as professionals, depend on our data. And the question always comes up: should an unusual gain of the type that Alphabet reported be included in the earnings results, or should that be taken out? And it's a fair discussion. We show with and without numbers just to give people a sense of what's happening. But a company like Alphabet, they have what they call as these moonshot other bets. They invest in these companies at the idea stages. SpaceX was one such idea for them. They have Waymo. They have a host of other investments like that. And when those investments mature, then they exit. And even if they don't exit, if the gain is just unrealized, accounting rules require that they book the gain. So one could argue that even though Alphabet is a tech company, it is in the business of investing in these startups and these new technologies. And those unrealized gains should be included in their results. And then there is the other side as well, that we should look at Alphabet as a tech company and just give them credit for their tech results.
While we're on the topic of big tech, they reported this week, as you said earlier. Are they and AI going to be doing the heavy lifting this earnings season to keep earnings momentum up?
Oh, absolutely. Yeah. Tech actually, so these unusual and blockbuster numbers that I'm coming again and again to are giving us growth rates that's in record territory. But as you know, Terry, and as our regular audience knows, tech has been a pillar of the aggregate growth for a long time, and that's the picture in Q2 as well. And then these Make 7 companies, the mega cap tech companies, they have been unusually strong in recent quarter. That's expected to be the case in Q2 as well. But the positive thing is that even if you look at the aggregate picture outside of the big tech and outside of these Make 7s, it is still a very strong and very positive growth picture. So all along. So yes, tech is giving you a big boost, but growth is positive outside of tech as well.
All right, let's talk more about that growth. According to published reports, I've seen Wall Street's forecast for S&P 500 profits over the next year has climbed to about $373 per share. That's up roughly 32% from a year ago. Are we witnessing an earnings boom here?
It sure is. It's an impressive earnings picture this year, next year. And the AI boom is a big part of it. You mentioned high gasoline prices that's boosting the energy sector. But as I keep telling our audience, the growth isn't restricted to one or a few sectors. In fact, we have 16 sectors versus the official Standard & Poor's 11, and we have all 16 sectors on track to have positive earnings growth this year. So yes, it is earnings boom all around us. That's why we have the market at record level or near record levels, because earnings at the end of the day, along with interest rates, are the fuel that drives the stock market.
All right. We want to remind our listeners, if they want to know more about what you're thinking on earnings trends and issues, they can just go to Zacks.com and access your current commentary on the earnings trends and issues. And these podcasts will act as something extra for them, too. With Shiraz Mian, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.